This is Macro Horizons, episode 361, My Punny Valentine, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of February 17th. And AI has just informed us that the beloved jazz standard, My Funny Valentine, isn't about a witty Valentine's Day card. In fact, it's a song about Val Lamar. Once again, technology is ruining it for us all. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the Treasury market had several major fundamental inputs from which to derive trading direction. We saw a disappointing retail sales print that came in at 0.0 for the month of December, and the control group actually declined slightly at 0.1%. On the flip side, there was a stronger than expected non-farm payrolls print of 130,000 jobs for the month of January. That also included an unanticipated drop in the unemployment rate to 4.3% and a larger than expected increase in nominal wages, with average hourly earnings printing up 0.4%. There was a downside surprise in headline CPI, however. In the month of January, CPI increased just 0.2%. The core CPI figures, however, matched expectations at 0.3, that's versus 0.2 previously, and on an unrounded basis, core CPI was 0.295 compared to December's 0.233. And as inflation continues to be comparatively benign, certainly versus the fears triggered by the trade war, we're looking at the combination of the recent data as keeping the Fed on hold in March, all things considered, but still clearing the way to resume normalization sometime in the first half of the year. In looking at some of the details of the CPI release, it's notable that supercore inflation printed at 0.593, which marked the highest since January of 2025. Now, clearly, there is seasonality to the inflation data. We tend to see higher prints at the beginning of the year and moderation over the course of the calendar year. So, in that context, these details were not particularly surprising. The core goods numbers showed a very benign 0.04% increase compared to 0.03 in December. Now, auto prices did drag on that, although for any investors still looking for strong evidence of tariff pass-through, any such pass-through has already been downplayed by Powell as simply a one-time price adjustment and not the true type of demand-driven inflation that would prompt the Fed to deliver a monetary policy response. This data all occurred with the backdrop of the February refunding auctions. The 3-year stopped through 0.1 of a basis point. The 30-year stopped through an impressive 2.3 basis points. The 10-year, however, tailed 1.5 basis points. Now, it's important to keep in mind, however, that the Treasury market was rallying off of the lows established in the wake of non-farm payrolls by Wednesday afternoon when the $42 billion 10-year auction was underwritten effectively at the highs or the low yield marks of the day, which puts the 1.5 basis point tail into context. All of these cross-currents still netted to 10-year yields dropping to within striking distance of a 3-handle, and that has certainly reinforced our medium-term constructive outlook on the Treasury market.
It was a week that was going to be defined by the jobs report, and it was. We got an impressive upside surprise in terms of January's headline hiring figures and a drop in the unemployment rate, which, despite warnings from Hassett and Navarro, and then the opposite of a warning from President Trump the night before the numbers, The actual payrolls figures were nothing if not solid, and even after JOLTS, Challenger job cuts, and some other more second-tier series added some concern that maybe the labor market was starting to inflect toward materially softer territory, we've made it another month with a relatively solid growth outlook intact, and another material data point that suggests the Fed is not going to need to continue cutting in the immediate term. All else equal, if we had known that NFP was going to double consensus, we probably would have thought that would have been a very Treasury bearish event. And it was, for about an hour. We got 10-year yields back up to the 420 level, which during the early part of this year, remember, was the critical buy target that many had highlighted. And after a brief period of selling in response to the data, Wednesday's price action revealed that investors are still in buy the dip mode as yields spent the bulk of the session retracing the initial move higher to grind back to end the day only modestly up. So if very strong payrolls data, followed very quickly by a 10-year auction, isn't enough to break us out toward higher yields, we're left to consider what can.
And you make a very good point, Ben. We've been in a trading range throughout the bulk of this year, and there was nothing that really came from the combination of incoming information that would dissuade the market from assuming that the Fed's going to remain on hold in March as well. Inflation came as it came. And even with that context, a lot of the conversation has been focused on whether or not the BLS employment report should be taken at face value. Yes, there was a strong headline improvement of 130,000 jobs, but the vast majority of those gains came from the healthcare sector. Most sectors of the real economy saw flat or slightly negative hiring. This concentration risk implicitly suggests that February's payrolls report will be more of a wild card than might otherwise have been the case if there had been broad-based gains in employment. We also saw pretty significant benchmark revisions for the period between March 2024 and April 2025. The BLS confirmed that payrolls were in fact 865,000 jobs lower than the latest revisions implied. All of this came in the wake of the prior week's series of weaker employment anecdotes. As you mentioned, ADP, JOLTS, Challenger, Revelio all suggest that there could be some lingering underlying concerns on the labor front. Let us not forget that we also saw a disappointing retail sales print for the month of December. Within the details, we saw the control group, which has the highest correlation with consumption within the GDP figures, unexpectedly decline 0.1%, which, frankly, was somewhat in contrast with what was generally seen as a reasonably strong holiday spending season.
And along with the retail sales figures, we also got the employment cost index for the fourth quarter, which came in softer than expected. Now, from a market moving perspective, it was probably that contraction in control group spending in the retail sales figure that drove the bulk of the rally ahead of payrolls. But more in the economic weeds, a cooling ECI holds longer-running economic cycle implications and, frankly, given what we've heard from the Fed previously, probably weighs just as heavily, if not more heavily, in the Fed's calculus of setting the level of monetary policy than December's spending figures. What we mean by this is that as the risk of a reflationary surge continues to simmer, there's still an ongoing debate about why the Fed is cutting, if the labor market is still at least okay, and the growth backdrop is similarly benign. What really matters from the Fed's perspective is a renewed surge of true demand-driven, not tariff-driven, inflation that's ultimately a function of higher wages and greater capacity to consume. Now, given ECI is a quarterly series, it's difficult to trade that information on a weekly or monthly basis, but in terms of the broader trajectory of wage growth, the fact that we're continuing to see cooling bodes well for realized inflation and inflation expectations remaining well anchored. Now, does that mean core PCE is going to be back at 2% anytime soon? No, not necessarily, but it also lessens the risk that we're going to see a renewed surge in inflation that calls into question Warsh's ability to continue delivering rate cuts toward that 3% level that he's previously highlighted. The correlation has been drawn between the current episode and what took place in the mid-90s in terms of growth being driven by higher productivity, which is inherently disinflationary, and it's in that environment, which we'll argue is exactly what Bessent and Warsh are going to be aiming for, that we can see strong growth in an economy running hot without the risk of resurging inflation. Clearly, 1 week's worth of data is insufficient to make that case just yet, but it's food for thought as we look out over the balance of this year with a new incoming Fed chair and another year of the current administration's fiscal policies driving the economy.
And I do think that the potential for AI to materially improve productivity is a very interesting topic at the moment. Yes, it could drive real GDP higher, but at the same time, it doesn't bode particularly well for the labor market, as the gains in productivity from AI are largely linked to the elimination of jobs as opposed to the creation of jobs, or at a minimum, it will slow the pace of hiring going forward. Yes, that has forward disinflationary implications, but at the same time, for an economy that's roughly 68% consumption, we're reminded that robots don't go to the mall, although no one goes to the mall anymore.
And looking beyond the economic data and to what's going on next week, we do get the FOMC minutes for the January meeting that will offer greater clarity around the first no-cut meeting in the past several months. Even though Warsh isn't on the FOMC yet, we'll also be on the lookout for any discussion among the current board members, who will still be board members once Warsh is chair, around how the thinking about the balance sheet is evolving, given the growing discussion and apparently appetite for the Fed to continue to shrink SOMA. It's not unreasonable to assume that the theme of the Warsh Fed is going to be far more about balance sheet policy than the Powell Fed was. And as we look out over the second half of 26 and into 27, it's going to be very relevant to see the buy-in from across the FOMC around this idea of cutting rates while also shrinking the balance sheet. There's a broader conversation to be had about just how effective quantitative easing and a larger central bank balance sheet is in driving actual economic growth, but it's clear that Warsh's goal in terms of stimulating the economy is going to be less focused on injecting liquidity via bond buying and more focused on driving credit expansion and easier lending via lower borrowing costs. Now, that's not only going to be a SOMA story, but it's become clear we're at the precipice of an environment where there's going to be greater collaboration between the Treasury Department and the Fed, and given the fact that Bessent, Trump, and Warsh all want 10-year yields lower, it's not unreasonable to assume that as we approach the changing of leadership at the Fed, we might start to hear more from current governors around how the combination of bank regulation, Treasury supply, and balance sheet policy may be coordinated in such a way to bring SOMA lower while also bringing Fed funds lower. Now, is it likely a highly detailed conversation about that dynamic played out at the January meeting? Probably not. But as we contemplate what the next leg of Fed policy is going to look like, we're going to be increasingly on the lookout for any information around how the committee as a whole is approaching that dynamic. The minutes and Fed rhetoric are probably going to be the best looks we get at that information before Warsh actually takes the helm.
And in an environment where there is greater coordination between the Treasury Department and the Fed, it does beg the question of Fed credibility and how monetary policymakers and the Treasury Department attempt to proceed with such coordination while maintaining independence and intellectual honesty. If nothing else, it promises to be an interesting experiment in central banking.
Yeah, so it's going to be more Washington Project than Manhattan Project.
I was thinking more Area 52. In the holiday-shortened week ahead, the Treasury market will continue to digest the implications from the payrolls report as well as CPI, to say nothing of the forward concerns triggered by retail sales. On the data front, there's not a great deal to guide trading outside of jobless claims on Thursday and, of course, Friday's release of core PCE. Expectations are for core PCE to have increased 0.4% in December. We'll also have the first look at the Q4 real GDP numbers, where the consensus is for a quarterly annualized rate of 3.0%, a solid end to a strong year of growth in 2025. The market will also have the FOMC minutes, which, while we don't expect will necessarily answer any of the broader-based questions about the composition of the balance sheet, nor, obviously, what it will mean to have a new Fed chair this year, the release will nonetheless be informative in terms of the Fed's reaction function to the incoming data, as well as some detail regarding the underlying motivation not to cut rates in January. Investors will look to the minutes for some context about the likelihood that the Fed does cut in March, specifically how members are viewing the trade-offs between the risk of inflation and a higher unemployment rate. Any discussion about the ongoing reserve management purchases will also be notable, although there currently seems to be no issues with functioning in the funding market for the time being. On the supply side, the Treasury Department will be issuing 16 billion 20s as well as 9 billion 30-year tips. Given the recent performance of supply, we suspect that an auction concession for 20s would be warranted, if not in outright terms, then certainly on the curve. This is all occurring with the renewed concerns about the state of the consumer following retail sales. While there are clearly cross-currents from the economic data suggesting that certain sectors of the economy might be under pressure, the path forward for monetary policy at the moment seems to be steady state, if nothing else. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And for anyone else worried about the aftermath of Friday the 13th extending into Valentine's Day, just remember, at least we'll have Monday's holiday to recover, hopefully. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.